Hi, in this section, we are going to learn about interest rate swaps. So this is part of FRM Part 1, Book 3, Financial Markets and Products. So first, let's go through the learning objectives, and then we will go through some of the main points in this section that you need to understand. So in this chapter, we will be learning about the basics of an interest rate swap, and then also how an interest rate swap can be used to transform a particular asset or a liability. We'll also look at the comparative advantage argument for interest rate swaps. We'll then look at how interest rate swaps can be valued in terms of bond positions and also in terms of forward rate agreements. We'll then look at currency swaps and how a currency swap can be valued in terms of bond positions. And then finally, we'll discuss a bit on the credit risk exposure in a swap position and some other types of swaps such as commodity swaps, volatility swaps, credit default swaps, and equity swaps. Now, before going through the details, some basic things to highlight is that interest rate swaps is not a difficult topic if you understand some of the basics. In other words, some of the basics on how floating rates work and also how the swap valuation works, the basics. Once you understand the basics, interest rate swaps are one of the easiest derivatives in order to explain and also to value them. So this is a very basic example. So you have two parties, party A and party B. Now this could be two different firms, or it could be a firm and a financial institution, or A and B can be simply two different banks. So what you see here is that A is receiving fixed interest rate from B, and A is paying fixed interest rate of 4% with semi-annual compounding every 6 months, and A is receiving a floating interest rate from B. One important thing to remember is that in a plain vanilla interest rate swap, we do not exchange the notional. Now here, even though we say it's 100 million notional, the notional itself is used only to calculate the interest payments. The notional itself is not exchanged. So that's something important to remember, especially in a plain vanilla interest rate swap. Now later we will be discussing currency swaps where the notional is exchanged at the beginning and at the end of the swap. But in a plain vanilla interest rate swap, the notional is not exchanged. The notional is only used in order to calculate the interest payments. So something else also to understand is that when we spoke about interest rates, we discussed something called day count conventions. Now, day count conventions simply means that if you're calculating the number of days between two cash flow payment dates, based on the day count convention that you will be using, the number of days can be different. So for example, when we are talking about floating interest rates in an interest rate swap, we normally use a day count convention called actual over 360 days. But for a fixed interest rate, in other words, for this cash flows, the fixed interest rate payments, we can either use actual over 365 days or 30 over 360 days. Now, when we discussed about interest rates and also interest rate futures, if you look at the interest rate futures chapter, you can see some examples on how the number of days will change based on which day count convention we use. But that's something to remember, that when you calculate the cash flows, we have to take into consideration the specific day count convention that applies to that specific cash flow. So here we have a interest rate swap between party A and party B, and let's assume that this interest rate swap has another 2 years to mature, and it pays and receives cash flows every 6 months. So that's what you can say here. The next cash flow is in another 6 months time, and then another 12 months time, another 18 months time, and the final one is in 2 years time. So this table is from party A's perspective. So you can see party A pays fixed interest rate. So that means every 6 months party A will be paying 100 million multiplied by the fixed interest rate, which is 4%, multiplied by 6 by 12, because every 6 months party A has to pay party B the fixed interest rate, which is $2 million. So that's what you can see here. Every 6 months party A will be paying $2 million and will be receiving a floating interest rate. So these are the floating rates applicable for each period with semi-annual compounding. So for example, the first one is 3.5%. So that's 100 million multiplied by 3.5% multiplied by 6 by 12, which is 1.75 million. So that's the cash flow party A will be receiving from party B. Now, one thing to also remember is that in an interest rate swap, both parties will not be paying the whole amount, but will be netting off. So in this case, minus 2 million plus 1.75 million. If you net off these two numbers, the net figure is minus 0.25 million. That means party A will be paying 0.25 million to party B. So both cash flows, if they are on the same date, they will be netted off, and only the net figure will be transferred from one party to another party. That's also something important to remember. Now finally, in terms of the floating interest rates, now let's assume you're somewhere here. If you're here, these three rates, 3.58%, 3.65%, and 3.72%, these are called forward interest rates because they are for a future period. For example, this 3.58% is a rate that starts in 6 months' time. This 3.65%, if you're here, it's a rate that starts in 12 months' time. So these rates are called forward interest rates. Now, if we are here, this floating rate 3.5% will be already known. So in other words, we call it, this rate is already fixed. Now, of course, all these are floating interest rates, but what we are trying to say is at the beginning of that interest period, the rate is already known. So you will already know this cash flow. And these rates are floating, forward floating interest rates. These are forward rates. These three interest rates are forward rates, but this rate, if you're here, will be already known. So this 3.5% will be fixed. So that's something to remember as well. Now let's look at how interest rate swaps can be used to transform an asset or a liability. So here, for example, firm A has borrowed $30 million by issuing a bond. And let's assume the interest that firm A has to pay to the lenders is a fixed rate interest of 3%. In other words, now firm A has a liability. So it has a liability, and the liability is fixed rate interest of 3% on 30 million. That has to, let's assume that this bond is a 10-year bond. So firm A has to keep paying 3% for the next 10 years, and at the end of 10 years repay the principal as well. Now if firm A decides to change this fixed rate liability into a floating rate liability, now this could happen for various reasons. For example, firm A might be thinking that interest rates are going to drop in the next 10 years, and therefore transforming the fixed rate liabilities into a floating rate liability might be much beneficial. Now in that case, firm A might want to get exposure to a floating rate liability. So the way to do this is that what firm A would do is that firm A we'll enter into an interest rate swap. So what you see inside this box is an interest rate swap. Now in this interest rate swap, you can see that firm A is receiving fixed interest rate and paying floating rate. The rate is LIBOR. Now this 30 million was only used for illustrative purposes. Remember, we do not exchange the cash flow on a plain vanilla interest rate swap. And you can see, because it's the same figure in equal and opposite direction, so they will get cancelled. So we don't actually exchange the notional principal. So this is a interest rate swap, and you can see firm A is receiving 2.5% as part of the interest rate swap and paying floating rate, which is LIBOR. So if you take the net picture, in other words, these fixed rates and these fixed rates will get cancelled off, and that will result in a payment of 2.5%, because you can see that party A is paying 3% on the bond, receiving 2.5% on the swap. That means the net impact will be just a payment of 0.5% plus the LIBOR. So that shows us that party A has transformed the 3% liability into a floating rate liability of LIBOR plus 0.5%. So this is one of the benefits of entering into an interest rate swap. You can transform a liability. At the same time, you can also transform an asset. For example, if you have already, let's assume that you have invested on a particular investment and you're receiving floating rate cash flows. You can enter into an interest rate swap to transform that asset into a fixed rate asset. But in this example, I'm showing you how to transform a liability by entering into an interest rate swap. Now we are going to look at the comparative advantage argument in interest rate swaps. So let's assume there are two firms, firm A and firm B. Now these are the interest rates available for firm A and firm B in the market. So the first thing you would notice is that firm B can borrow at a lower rate in the fixed rate market and in the floating rate market compared to firm A. Now that suggests that firm B has a better credit rating compared to firm A. In other words, firm B might have a better financial status, or firm B might be large enough and safe enough compared to firm A. So firm B definitely seems to be having a better credit rating than firm A, because firm B can borrow at a cheaper rate in the fixed rate or in the floating rate compared to firm A. Now the interesting thing is that if you look at the spreads, now when we say spreads, basically what we are saying is the difference between the borrowing rates. If you look at the spread in the fixed rate interest rates, the difference between 5% and 3%, the spread is 2%. Now the spread in the floating rates is only 0.8%. So that means that for firm B, we say that firm B has a comparative advantage on the fixed rate market. Because the reason we say that is, if you look at it, of course firm B has a better interest rate, can borrow at a cheaper rate compared to firm A in both markets. But firm B can borrow 2% less than firm A in the fixed rate market, but in the floating rate market can only borrow 0.8% less than firm A. So that means firm B is definitely in a better position when borrowing in the fixed rate market, because firm B can borrow 2% less than firm A. So we say that firm B has a comparative advantage on the fixed rate market. Now the same way we can use the same argument to say that firm A has a comparative advantage on the floating rate market. In other words, of course firm A has to pay more than firm B in both markets. But in the fixed rate market, firm A has to pay 2% more than firm B. But in the floating rate market, firm A has to only pay 0.8% more than firm B. So we say that firm A has a comparative advantage on the floating rate market. So what does this mean? Now, a swap trader would say firms should always borrow at a rate which the firm has a comparative advantage. And then if the firm prefers a different interest rate, so like for example, now here we are saying that firm A has a comparative advantage on the floating rate market. So what that means is firm A should always borrow at floating rate because that's the market that the firm A has a comparative advantage. And then if firm A wants exposure to a fixed interest rate, firm A should just simply enter into an interest rate swap rather than directly borrowing in the fixed interest rate market, because here we can see if firm A goes directly to the fixed interest rate market, firm A will borrow at 5%. But instead of borrowing at 5%, if firm A borrows at the floating interest rate, because it has a comparative advantage, and then enters into an interest rate swap to swap those interest rates to get exposure to a fixed rate, it might get a fixed rate less than 5%. The same thing with firm B. Now firm B, if for example, if firm B wants to borrow at floating rate, but we know that firm B has a comparative advantage on the fixed rate market. So rather than borrowing at LIBOR plus 0.1%, as what a swap trader would say is that firm B should first borrow at the rate it has a comparative advantage. So in this case, it's 3%. Borrow at 3% and then enter into an interest rate swap to transform this fixed rate into a floating rate, and that will give you a better rate than what the market will offer. So let's see how this can be done. So first let's start with firm A. So what we are saying is firm A should first borrow at the rate it has a comparative advantage. So we are saying firm A has a comparative advantage on the floating rate market. Remember, because in the floating rate market, firm A's spread is only 0.8% more than firm B compared to the fixed rate market, which is 2% more. So firm A should borrow at floating rate of LIBOR plus 0.9%. So that's LIBOR plus 0.9%. And then firm A should go to the market and enter into an interest rate swap. So if it enters into an interest rate swap, let's assume that it receives LIBOR and pays a particular fixed rate, and let's assume that rate is X%. So this is the net position will look something like this. Now the net position will look something like this. In other words, firm A is borrowing at the rate which has comparative advantage, which is LIBOR plus 0.9%, and then enters into an interest rate swap to receive LIBOR and pay a particular fixed interest rate. And we are saying that interest rate is X%. So the benefit for firm A, rather than just going and borrowing at the fixed rate, which is 5%, so the benefit would be 5%. So in case if firm A doesn't do this, firm A, let's assume that firm A just directly goes and borrows at a fixed rate, that will be 5%. So the benefit would be 5% minus the net of this is X plus 0.9%. Remember, LIBOR and LIBOR will get cancelled because these are opposite directions. Firm A is paying LIBOR here and receiving LIBOR here. So LIBOR and LIBOR will get cancelled. That means firm A will pay X% plus 0.9%. X% plus 0.9%. That's the total of all these three cash flows. X plus 0.9%. So the benefit for firm A should be the difference between 5%, which is directly just getting a fixed rate, and X plus 0.9%, which is 4.1% minus X. That's the benefit for firm A. Now the same way we can calculate the benefit for firm B. So firm B, we said the firm B should borrow at a floating rate because the firm B has a comparative advantage. So firm B, we said, should borrow at a fixed interest rate because that's what firm B has a comparative advantage. We said firm B can borrow cheaper, but in the fixed rate, firm B can borrow 2% cheaper than firm A. So firm B should borrow at 3%. So that's what you see here. That's the first transaction. And then if firm B wants exposure to a floating interest rate, firm B should enter into a swap. That means pay LIBOR and receive X%. So in other words, it's the same swap as this. So firm B is taking the opposite position. So that's the swap that firm B will be entering. Now, rather than going directly to the floating rate interest, so if firm B would have gone directly to the floating rate interest, firm B would have got LIBOR plus 0.1%. So that's what we are showing here, LIBOR plus 0.1%. Now, by doing this, by first taking advantage of the comparative advantage, which is 3%, and then swapping it into a floating rate, firm B will achieve this rate here, which is LIBOR plus 3% minus X%. LIBOR plus 3% minus X%. So that will be the rate that's achieved through this transaction here. So the benefit for firm B by doing this is the difference between these two, which is X% minus 2.9%. So we have calculated the benefit for firm A is this, and the benefit for firm B is this. Now let's assume that both benefits are equal. In other words, firm A and firm B are equally sharing the benefit. So that means these two figures should be the same, and that gives us X equals 3.5%. Now what does this mean? See, in other words, X is 3.5% means the fixed rate in this interest rate swap is 3.5%. So if X is 3.5%, what that means is you can plug in this 3.5% to firm B, this figure here, to calculate what firm B would have got. So we can, I'm showing this to you in blue. By doing this interest rate swap, firm B would have got a rate of LIBOR minus 0.5%. And the same way, by entering into this interest rate swap, firm A would have got 4.4%. You simply just plug in the rates here and you can calculate that. So what does that mean? Now you can see that if firm A would have directly gone to the fixed rate market, firm A would have got 5%, borrowed at 5%. But instead of doing that, if firm A would have taken advantage of the floating rate market, because that's where firm A has a comparative advantage. In other words, what that means is borrow at LIBOR plus 0.9%, and by entering into an interest rate swap, firm A was able to achieve 4.4%. You can see firm A was able to borrow at 4.4%. So there's a benefit of 0.6%. Firm A saved 0.6% in the fixed rate market. And that's what we can calculate here. Firm A saved 0.6%, 4.1% minus X is 3.5%. That's 0.6%. You can see firm A saved 0.6% in the fixed rate market. The same way, firm B saved 0.6%. You can see LIBOR minus 0.5% is less than LIBOR plus 0.1%. So the comparative advantage argument tells us that by taking advantage or borrowing in the rate that a particular firm has a comparative advantage, and then by swapping those rates by entering into an interest rate swap, a firm can save on its borrowing cost. Now, this argument will only work if the credit ratings of these firms do not change over the period of the swap. For example, now we said that firm A has a comparative advantage on the floating rate market. In other words, firm A can borrow at LIBOR plus 0.9%. Now assume that firm A's credit rating slightly changed after some time. Now what that means is firm A will not be able to borrow further at the same rate, because remember, when a bank lends to a firm, and if the firm's credit rating gets worse, and if the firm is borrowing at a floating rate, that means the bank will start increasing the interest rate to cover the risk. Now that doesn't happen in the fixed rate lending, because once you lend at a fixed rate, that's it, the rate is fixed. But in a floating rate lending, if the credit rating deteriorates, the bank is going to charge a higher interest rate. So the comparative advantage argument only stands when the credit rating of the firms do not change, especially the credit rating of the weaker firm do not change. So only then the comparative advantage argument will work. So that's something to remember.